So how do these super traders who make a mammoth amount of return pick winning stocks again and again and again? This is basically the topic which we have been covering since the last 1 week in the series of decoding the CANSLIM strategy by William O'Neils from his book How to Make Money in Stocks. So we have already covered C, A, and now it's time for N, which is new products, new management, and new highs. So if you want the stocks that can multiply many times over, stop chasing old cheap names. The real big winner has usually something new. A new product, a new leader, or a new trend that's changing the game. That new factor is what sparks the wave of growth. And you buy these when they're forming a proper base and breaking out with volume, not when they're buried in their 52-week lows. So why does the new matter? So every great stock story starts with something fresh. A breakthrough product, a visionary management change, or a brand new industry being born. Whenever innovation hits, earnings and sales can suddenly accelerate. And that is what drives massive price runs. From the industrial age to the internet era, railroads, autos, computers, smartphones, nearly every huge stock winner has been tied to something new. Studies show over 95% of history's biggest stock winners had one of these. A new product, new company, new management, or new industry conditions. That's not a coincidence, that's just the pattern. Let's look at the stock market's great paradox. Here's something most people get wrong. We're all wired to look at bargains. We want to buy low, but in the stock market, that logic backfires more often than not. So the great paradox is the stocks that look too high usually keep going higher, and the ones that look cheap and beaten down, they often keep falling. The best performing stocks always hit new highs on their way up because that's literally how they move from $50 to $100 or beyond. So instead of buying cheap, look for leaders making new highs on strong volume. That's where the real momentum starts. So when to buy, the timing actually matters. Not every high is a good buy. Not every high is a good buy. That rhymes. That's not the good buy I'm talking about, the good buy, like buying. You want to catch it as it breaks out of a proper base, not after it's already run up. So here's how it actually works. A base can last few weeks to over a year. It's a period where the stock consolidates, shakes out weak hands, and builds power. The right time to buy is when it clears that base on increased volume. Avoid chasing it if it's already 5 to 10% above the pivot point. That's how people get shaken out during normal pullbacks. So here's a pro tip: buy the breakout, not the runaway. So how does a stock actually double? Think about it. If a stock trades between 400 to 500 and you want it to go to 1000, it has to pass through 510, 520, 530, meaning it must make a series of new highs. So when you buy a stock breaking into new high territory, you're actually aligning yourself with the strength and not against it. That's how these big moves start. So again, let's repeat that. What kind of new things are we looking at? Throughout history, almost every legendary move has come from something new. A new product that changes how people live, a new management team that revamps an old company, a new industry that opens up a massive demand. The point isn't to chase the hype, it's to recognize the real innovation backed by real earnings growth. Because when something new creates strong, accelerating profits, the chart always shows it. Price and volume explode together. So according to the book, here's a little lesson from the market history. Whenever multiple companies launch in a new sector, say clean energy or artificial intelligence or biotech, amongst them a few become leaders. Those are the ones showing new ideas, new highs, new momentum, and if you plot their charts, you'll always see the same thing. A proper base followed with a clean breakout with volume. Meanwhile, the cheap stocks in the same group, they usually fade away or never recover. So quick rules that you can use right now. Look for something new, like a new product, new management, or new industry. Second is buy at the breakout, not after the stock's already taken off. Third is to avoid cheap stocks. Just because they have fallen, cheap can actually get cheaper. Fourth is never chase if the stock is more than 5 to 10% above the pivot. And 5 is use weekly charts to spot clean base formations and volume surges. So the final takeaway out here is every major market cycle brings a new wave of innovation, and with it, stock leaders. Your job isn't to predict them all. It's to recognize that new when it starts showing up in the chart and in the numbers. Because in the end, the next big winner, it won't look cheap or familiar. It'll look new. And that's exactly where the magic begins. Now, if you think I've added some value, please hit the like button. Please press the subscribe button. And if you haven't already watched the CANSLIM, the two videos which I've already done earlier, the C and the A, please go watch them right now. It's pretty informative as well. And again, if you're new out here, do subscribe. I have amazing topics which I am going to keep covering. And yes, saying that, see you in the next one, where we are going to cover the S. I don't know how to do S because I wanted to get it for my thumbnail. Let me see. Maybe this will work. I don't know. Or I'll just do like this. S. So S stands for supply and demand, shares which are outstanding plus big volume demand. So see you guys in the next one.